Hello, hope everybody's doing great. AP is here. Let's get towards the first video on how to trade the corrections. These are going to be three-part videos. The first one will talk about where does the correction start, how do we identify the start of the correction, which is the most important point. Even if you don't want to trade corrections, you need to understand where they start in order to omit them. The second part of this video is going to be about what are the shared qualities within the corrections, and as such, what are the most likely setups that you can encounter when you're trading a correction. This will be the parts that I will try to make as crystal clear as I possibly can, because without understanding those, we can't get into the second and the third part of this how to trade correction series, where we'll be discussing the second part, how to identify Elliott wave corrective patterns and how to use that for your advantage and higher accuracy within the range. And the third one will be how to trade reversals out of the correction, which will evidently require a different skill set. So now that we have clarified our syllabus, let's get towards the chart and first of all understand what a correction is, what are our expectations when we go into correction, and how can we identify that the one has actually started on the chart. If I would ask anyone, what are the corrections? What are the qualities that you could assign to the corrections? They would probably highlight the following criteria. Price just doesn't move, price is slow, it takes a lot of time, there is a lot of overlapping and stop hunts. I'm even recording this. Okay, good. Right? And this is essentially a result of low volume. Volume is low. And the fourth piece is that it's trendless. Essentially, it's trading within the range. So if we would be looking at the following criteria, and you're a little bit familiar with Elliott wave concepts, you'd be like, okay, so when we have actually identified that the correction is started, we can expect a range to form. It is important to understand, you expect the range to form. You expect this range to last for at least 3 times the amount of previous trend, and you compare the structures within the same direction in terms of time. So when you're dealing with a correction, you're looking at the structures in the same direction, not in terms of price similarity, but in terms of time similarity for a degree standpoint. So if you would look at one-to-one extension here for ETH, right, in terms of price, when you're looking at impulse, you'll be looking at the same time for the legs in the same direction within a corrective pattern. Okay? So once again, here are a few things that we should understand. Corrections, when they start, they will form a range. The range that will take at least 3 times the time that has taken the previous trend to develop. Right? Now let's get towards the chart, and we will be using ETH as an example. So first things first, where did we actually have our trend starting and what is a trend? So many people have different definitions of trend. In terms of market structure, I follow the classic one. If it's a bullish trend, you expect higher lows to result into higher highs. And if it's a bearish trend, you look at lower highs to result into lower lows. So let's take a look at ETH. So let's start from here. So we had a low, had a higher low, has resulted into higher high. We had a higher low, resulted into higher high again, higher low, higher high, higher low, higher high, higher low, higher high, goes down, creates a lower low compared to this one. Then we get one more lower high, one more lower low. Now we know that in Elliott wave we have either 3-wave structure or 5-wave structures. 3-wave structures, any A, B, C, W, X, Y, doesn't really matter. 5-wave structures, you have W, X, Y, Z. Now some people will argue that is a 7-wave pattern. I disagree. I will be talking about that in the second part of the video. But A, B, C, D, E, convergent 5 waves, W, X, Y, Z, trendless 5 waves, and 5, 1, 2, 3, 4, 5, so just an impulsive channeling 5 waves. You need to understand that the end of a corrective pattern or the end of a pattern is not the end of the correction itself. This is a piece of understanding that many Elliott wave traders lack, and you need to look at the following, at the range, at time, in order to say that the correction is very likely to be complete. Okay? So here we have a lower low, lower high, lower low. The structure is broken at this point. Let me remind you about the mistake that many people were getting through. It's not their fault, but you need to understand that in terms of common sense, because those provide a very good trade opportunity. Most of the time they provide a maximum pain type of opportunity when a lot of people are trapped. So let's refresh. We were looking at the creation of the range once the correction is started, and the correction has started here with the break of the market structure, right? So we're looking at the range. We took our top here, our bottom of the A leg, and we drew a little square here. Essentially, when you're trading within the range, you want to do the following: sell the top, buy the bottom, right? As simple as it can get. Now, here are a few things that you should keep in mind as well. Corrective counter-trend structures tend to lose volume. So here is volume with a moving average. You can see that the volume here on the A leg actually started to spike. It was rising, and then it was slowly declining through this move up. Look at the amount of this volume that came in close to the top. These were literally people buying the top. And those are the opportunities that I call maximum pain setups, as you get people trying to trade into double top in the structure that actually had told you that the range is going to begin and you are coming close towards the top. You shouldn't expect a breakout out of it. Experienced traders, when dealing with range, they expect the range to continue, and I use my general rule of thumb for 3 times the amount of time in a previous trend to be spent within a correction. So here we have 9 days of a trend, so I would expect 9 times 3, 27, at least 27 days to be done. So at least here I will be starting to see, are there any buy setups? Is there any structure to go off? Is there anything similar for me to trade the reversal from the correction? Even if it doesn't do, okay, so I look until the structure gives me the clue, but I don't try to force any completed structure narrative, any movement, until I will have my rule of 3 times the amount of time spent in the correction of the trend took to develop. Now also, let's pay attention to the following. Here, had a move up in a B wave, correction, you can expect one more strike for an A, B, C, right? But look, you had a higher low, higher high, higher low, higher high, higher low, and here you fail to break the high. So you just have a high here, not a higher high, and you have a higher low here. What happens here? This low is lower than this one. This is a lower low, this high is lower than this low, so this is a lower high. So essentially, the downtrend has started here. You had a lower high resulting into lower low. You also had the break of a degree structure in terms of a trend line here, so you would be looking by default to be shorting with your stops resting here and targeting the bottom of this range. So you'd say, okay, the B wave looks complete and I will be shorting to the downside. And those people that remember me going through the setup, remember we were taking this trade and we were getting here and here within the short as the bottom, which is quite a good one. At least it's one of the clearest examples that I can find in crypto on the clean shift in a structure for the past 2-3 months. Others need a little bit more discretion. Now, when you're dealing with a correction, you should pay a lot of attention to time. And you should understand that, for example, a move that has taken 3 days and 12 hours, let's say 4 days, to move X amount of price, and the move that has taken 3 times the amount, the time to move the same amount of price, are different in strengths. The second one being weaker, evidently. So now that we have gone towards this 7-8 minutes of explanations on what corrective structures are, where the correction begins, how much time can I expect that range to hold, we can go towards the most basic setups that you can take based on Elliott wave theory when you're trading within the range. And since most of you guys are trading crypto, I'll be looking at BTC as an example because this structure is repeating all the time, just in different shape or form, and you can pretty much, if you understand how to trade this one, you will be able to slay any ABC correction. Now, essentially there are 2 ways, like this one, just spikes down, creates a shallow spike up, and then reverses back, like here, for example, right? Very similar. Where was it as well? This one, similar in terms of structure, essentially. Where's it split? Essentially the same stuff. And the most widespread, which can be found here. You can also see the internal formation of an A, B, C here is repeating all the time. Look, essentially this one as well, and if we do a little bit of mental gymnastics here, you can see the similarity here as well. So let's look at this piece, price action. How can we actually trade it? What are the most typical trades that you can take? Now, an A wave doesn't have triggers within the corrections itself. You need to be looking at the last leg of the trend in order to identify that short, and this is going to be the reversal part in the third. But the trades that you can take within the corrections start within the B wave, which is normally the most time consuming part of the correction, and the C lags that you can trade down. So whenever you have an A lag formed, remember that it will be a magnet for the third leg down coming, which will be a C. When you're dealing with the structure which is internal, an ABC for B or some sort of a WXYZ for X, we'll be going through those in the second part, and I'll be describing in depth what is the difference between those. But basically, there are two traits that you can take within the B wave. The first one is that whenever you get the spike up, you get the first leg up, when you see a cell forming, you can take it because B waves often are coming close to the A low bottom. So in this case, you would be taking short cells here, and you would be trying to sell it into this low. I mostly target 0.618 FIB or 0.786 just to take profit level, so 0.618, 0.786. What is the next move? Next move, you're like, okay, B lag. What does B lag consist of? It can be any corrective structure, but most likely it will be some sort of a WXY, ABC, which are in essence both three-wave structures, or a WXYZ, which is a compacted five-wave structure. What can I be dealing there? Well, if it's going to be an ABC or WXYZ, I can mark the top of the A of the B. So let's make this an uppercase and it's a lowercase a. And once I see a buy and setup here, I'll be trading up to this high of an A. And then once this high is taken, it's not a contracting flat, etc. We're just going through basic examples. You can look for a sell setup on the third leg within the B. And you'll be targeting what? Exactly, you'll be targeting the initial A low. So to recap the entire video, correction starts when you have the break in market structure and it starts forming a range. A range which will consist of an upper boundary created by the high of the impulse and the lower boundary being the first leg of the corrective structure that broke the previous trend. Right? These ranges tend to last 3 times the amount of time that the previous trend took to develop. Your sole goal within those structures is to try to get as close to the top for sells and as close to the bottom for buys. When you're dealing with these structures, you need to understand that you compare the moves in the same direction in terms of time. So for example, and of the same degree, this leg down, this A leg, it took 3 days and 16 hours. Let's see how long this one took. 5 days and 8 hours. And you would be looking at B here to take 3 times the amount of this move down. So let's remind ourselves, we had 3 days and 16 hours, and here we had 11 days, 20 hours. So this is more of a rule of thumb when you're going towards can it be usable? Yes. So if you don't see the completed structure and it's under the time consideration of 3x rule, most likely you're just dealing with some sort of a difficult connective tissue that you can't identify yet, and you need to just wait for an opportunity to come and trade the chart that you know and expect the completion of that move at a given time, right? Anyway, I hope you found this video useful. This is my first time trying to record a tutorial video in some sort of depth. So if there are any questions or you're still unclear or on where the correction begins, how long you should expect the range to last, and what is the typical mindset you should come in towards. The setups within the movement, please let me know. In this video I've tried my best to give you the most high strike rate setups that you can take, and hopefully you'll find this useful.